Spend management in practice. How much is potentially up for grabs will vary by institution. But when employing this approach at multiple financial services clients, we've identified and captured savings of 15% on $300 minus $400 million in contingent labor spend, and savings of upwards of 20% on more than $10 million of print-related spend. With the demand for innovation dollars only intensifying, the potential bottom-line savings cannot not be overlooked. While interest rates are rising, the market continues to be volatile and inflation is squeezing consumers and businesses alike, putting pressure on traditional sources of banking profitability. The threat of deposit runoff remains top of mind. There's a continued lack of efficiency among banks' current operating models. ROI on the status quo is shrinking, and 2023 presents the opportunity to build more digital and AI optimization into your organization. With banking becoming increasingly fragmented, and the rise of fintechs and acquisitions, banks must lean into automation, AI, and data analytics to build a digitally driven operating environment and digital mindset among employees. It won't be an all-at-once overhaul but rather a step-by-step journey toward a zero-waste operations model that reduces costs to be reallocated toward innovation and/or trimmed to help margins. Just 44% of leaders gave themselves an A grade when asked about the maturity of their access to and use of data. Though banks have done a better job of gathering data and improving quality, a disconnect remains in terms of how data is used, and there continues to be room to enhance the efficiency ratio and reduce overall portfolio risk along the way. Up next, instead of sporadically cutting costs, implementing an efficient operations goal and the right technologies can significantly reduce operations overhead, shift and enhance productivity, and potentially alleviate tight margins. If done properly, this becomes a scalable digital foundation that empowers human capital more effectively, facilitates growth, and positions the organization for success through economic uncertainty and the modern day's increasingly digital approach. The need for banks to attract and retain new customers must be balanced with the need to keep highly profitable current clients who often prefer in-person, traditional banking experiences tied to digital banking solutions. While the notion of omni-channel is still evolving, it implies that banks can. While customer segmentation is likely accessible in lending customers, is it as accessible with deposit customers? Targeted data insights will enable banks to proactively identify potential weaknesses, withstand uncertain market conditions, and capitalize on opportunities for expansion. Amid increasing interest rates, economic uncertainty, and heightened public concerns, banks must also answer the following. Who are my stickiest and most loyal customers? Are there early warning cues to signal attrition or runoff? Is our portfolio exposed to concentration risks? Are their channels more optimized to bringing in stickiest deposits? Do we have an over-concentration of customer base in a given vertical industry segment? Up next, focus on treasury management. And often overlooked by source of stable deposits is treasury management. Having consistent, repeatable processes that identify risks and opportunities can equip banks with the right momentum as they seek additional paths toward growth. Small business comes into sharper focus. Digitizing small businesses can boost features, efficiency, and profit margins while reducing risk through increased granular deposits. We're living through the peril of a fragmented industry as we speak. The pace at which money moved out of SVB and into fintechs is dizzying. How will banks bring these deposits back? The question of relationship primacy remains an opportunity for banks, and is turning more into a mandate, as banks consider how they can bring customers back in, and keep them. Given the sheer volume of non-traditional challengers to banks, the question of relationship primacy is top of mind for executives. The number of banking relationships per customer has increased exponentially and the downstream impacts are starting to be acutely felt on bank balance sheets, with customers divvying up their deposits between traditional banks, digital currencies and wallets, and even retailers. The need for investment in technology to create customer-centric experiences and embrace new models like banking as a service will better enable this relationship management is perhaps even more punctuated. The ease with which customers can move money, and know it will be safe, cannot be underscored. Up next, Now is the time to identify fragments, centralize opportunities and value, and double down on digitally driven solutions to help manage, target, segment, and capitalize on areas of growth. In our 2023 outlook, The Future of the Banking Industry, we anticipated murky waters and a rising need for the use of digital solutions to better evaluate profitability, identify key customer touchpoints, and work to prevent deposit outflows and overconcentration. Banks have had to make swift pivots in the first half of 2023 to maintain stability and deliver top-tier customer experiences amid ongoing uncertainty, inflationary pressures, and rising interest rates. The mid-market is the center of discussion across the industry as volatility and deposit outflows heighten following the fallout of Silicon Valley Bank and First Republic. Discussion around uncertainty and the continued looming of a recession or banking crisis only grows as banks are forced